Hey everyone, welcome to the KE Report. Getting a company update from Metalla, Royalty, and Streaming, chatting with the CEO, Brett Heath. We are going to be recapping the Q2 financial results that were released earlier this month, as well as some of the asset updates, where the near term growth is coming from in the next 12 months, and then even looking a little bit further out. Metalla is traded on the TSX Venture Exchange and the NYSE under the symbol MTA. Now, Brett, let's start off with a bit of a recap of the Q2 financial results. Total revenue from royalties just in the 3 months ended June 30th was over $2.6 million. For the 6 months, it was almost $4.5 million. I believe this is one of the best quarters for the company in terms of revenue, which makes sense with these higher metals prices, but also gold equivalent ounces from your royalties and streams. So, Brett, give us a bit of an overview of Q2. What happened there, where the revenue came from?
Sure, Corey. So we reported strong financial growth in Q2 2025, and we saw royalty revenue increase 208% year over year to 2.7 million. And that was driven by 840 attributable gold equivalent ounces of production. And we realized approximately $3,289 per ounce. So noted the high gold prices obviously help out quite a bit. But an important note within the Q2 is our adjusted EBITDA rose significantly to 1.5 million from just slightly positive at 200,000 the prior year. And what's exciting from here is that the Endeavour mine has now recommenced operations, achieving cost targets in its first full month, producing 5,398 dry metric tons of silver lead zinc concentrate in July. And our cash flows, even though this asset was producing concentrate and stockpiling concentrate in May and June, our cash flows are based on the sales, and the first sales occurred in July. So we expect to see significant and kind of record growth in EBITDA and revenue through the balance of this year.
So, Brett, the question always being near-term growth, then, if we can assume that your baseline revenue and baseline gold equivalent ounces are at what we saw for the 3 months ending June, where does the growth come from? What sort of growth will we see within the portfolio?
So in the near term, Endeavour will be a large driver of the revenue growth. And so as we get our first royalty check from that asset in Q3, that should kind of continue to ramp up into Q4. And by 2026, we should expect a full year commercial run rate. We also have Amalgamated Kirkland that has been guided by Nico Eagle to be in production, start production in Q4 of this year with a significant ramp up into 2026. We also potentially may see some production out of La Paria starting in the first half of 2026 as they work through their restart process and program. So a lot of action on the growth side of the business with a number of royalties coming online here within the next 12 months.
Just remind everybody the royalties that you have or the deals that you have for that Endeavour mine, for that Amalgamated Kirkland, and can we estimate potentially how many, let's say, gold equivalent ounces you would have coming to you over that 12-month period?
Well, the midpoint of our guidance for 2025 is about 4,000 gold equivalent ounces. So that positions the company to have kind of a heavier second half. We have not given guidance out yet for 2026, but what I can say is that it should be substantially higher than kind of where we're at for 2025.
What about looking to 2027 then? Let's look a little bit further out than just the next 12 months. Any major growth assets within the portfolio that we should be aware of?
So the big piece of growth in 2027, and also will be a big catalyst in 2026, is the Côté royalty, Côté Goslin. And there's two parts of this. There's the Côté royalty, where we have part of our royalty property goes into the Côté reserve pit. That's the existing mine that's in production today. They're phasing from the south to the north of the pit, and our royalty covers the north, and that should come online in 2027. But the really exciting piece of this is the integration of Goslin. And IAMGOLD has guided to the market that they're on announcing drill results in Q4. So they've got about upwards of 100,000 ounces 100,000 meters that they have not included in an updated resource for Goslin and resource and reserve for Côté. We expect this to happen probably in Q1 of next year, but again, like we should see the drill results come out probably in Q4, and that'll kind of point to kind of what we're expecting in Q1. But we expect a pretty big jump on that, and then on the back of that, we should get the integrated Goslin part of this new mine plan, and that expectation is in the back half of 26, and that could be very, very significant for our business and a major catalyst as it really daylights the value of the expanded Goslin deposit.
So, Brett, outside of the growth within the portfolio, what about M&A? Look, the sector is very active right now. There has been a lot of money raised from the large caps down to the juniors. A lot of work is underway, and it does seem like companies are trying to develop their projects. They're not just sitting on the sideline right now. They are trying to take advantage of these higher metals prices. What does that mean for a company like yours that goes out there and acquires royalties from usually projects that aren't built yet?
Well, the M&A within the royalty, with the recent announcement of Sandstorm Oil, really going to tick things up in regards to quite a bit of kind of tension within the sector. And I think what we've seen over the last 18 months is really there's been such a significant increase in market cap and free cash across the majors and even to the mid tiers at a bit of a lesser extent. And in fact, we saw over the last 18 months, the majors market cap as a group has increased over $30 billion. And so, just to put that in perspective, that basically took about 40 years for the entire sector to get to 30 billion of combined market cap. And so what we're seeing is with these significant expansion in free cash, like the top three royalty companies are now kicking off or expected to kick off over $4 billion of cash this year. The opportunity set just did not grow at that same rate. So when companies can in their free cash, double in size in a very short period of time, the transactions that really can have the ability to make a material impact on their growth start to shrink. And so that usually puts heavy pressure on M&A, and I think that kind of goes across the mining sector for similar kind of circumstances, but within the royalty sector specifically, it should be some exciting times, but, I think it's a great opportunity for, investors to roll up their sleeves and look at some of these high quality juniors, because the juniors are now relatively outperforming the majors. The junior indexes are outperforming the major indexes. We're seeing relative outperformance across the board with the juniors, and you still can buy juniors at pretty incredible prices, pretty attractive valuations. And they have not, they've moved, but they still have a long, long way to go, because if you remember, the first year of this bull market, the juniors really didn't do much at all. For the most part, we did not see, inflows. We did not see a lot of financings happen. We did not see, the share prices and kind of significant uptrends, outside kind of a few outliers. But we're seeing that now. And the way that kind of we're looking at it is I think that it's just getting started.
Yeah, it has been very encouraging, especially the last maybe 3 months, seeing the juniors playing some catch up and all the money being raised. We have seen a little bit of, I guess, softness to end summer here. But Brett, what does that mean for a company like yours? These companies maybe aren't as desperate for money right now, but if they do want to go through a build, then yes, they do look at all the options, and royalties and streams are one of those. But again, you purchase a lot of royalties and streams that are already created. So does this mean that you're getting more aggressive out there?
Well, we took a longer term view when we built our portfolio, and we really focused on high quality development. And that was in regards to valuation and how the market was treating and valuing these assets. That kind of was a bit of a hurdle for us, just because the market really valued development at a much lower rate. That inevitably hurt kind of where we traded versus peers over the last couple of years. But I think it's flipped. I think now it's a big positive outlier for Metalla, because now at the time when things are very competitive, metal prices are going a lot higher. We have bought and paid for all of these different assets, and now they're all coming online. We've got, as we noted earlier, a few new assets coming online within the next 3 months, and then we've got a few more and kind of, or sorry, the next 12 months, and then we've got a few more kind of in the following year and year after that. So we should see significant growth. I mean, we've got a whole several catalysts that are just filled of all these assets now that these companies, with the higher gold prices, they're funded, their balance sheets are strong, they're all advancing these projects, they're drilling them, they're advancing them faster to production. A couple to note, we saw Equinox Gold's Castle Mountain, where we have a 5% royalty that covers approximately a little over 2 million ounces of gold on that project, get accepted into the Fast 41 program. So now this is under federal permitting. That means that this project likely will get permitted by the end of 2026. And it's Equinox's, or the pro forma Equinox kind of Calibre merger's main development asset. And this asset has potential. No, they haven't put out their new mine plan. So this is kind of, this is a best estimate. We don't know what that's going to look like. But we suspect that the production profile on this asset may be somewhere between 200 and 240,000 of gold ounces per year. And there's potential that most of those ounces come out of our ground in the early part of the mine plan. And we have a 5% royalty on that. So just to put that in perspective, that could be somewhere between 5,000 and upwards of 10,000 gold equivalent ounces a year of additional production that would come online kind of in the 2029 timeframe, maybe end of 2028 if they can really push it. But this is significantly more than our entire guidance that we have for 2025. So when you look at kind of the embedded growth and the embedded optionality in our portfolio, and what is really real from a development perspective, like I said, this is a big company. The permitting just got locked into the Fast 41 program, and they have the balance sheet to build this mine. This is significant growth. We also saw Hudbay Minerals secure a $600 million joint venture with Mitsubishi on Copper World. So what this basically means is it de-risks the rest of the capex for Hudbay. They basically can finalize the DFS and then have a construction decision, also targeting probably kind of 2029, 2030 production for this asset. Our estimate is that Hudbay probably needs another $200 to maybe upwards of $400 million to fund this asset, which can be easily done in this capital market. So it's great to see that asset now fully permitted, a joint venture partner announced, and basically very little capital needed, or more or less kind of fully funded for that asset to go production and have a kind of again, these really significant assets kind of that are becoming very real and in the near term for us. Another one is G Mining's Gurupi project. So this is an asset that already has well over 2 million ounces on it. It has potential to go well beyond that. And there was a significant injunction that was kind of holding that project up at the social level that has now been removed. G Mining is going to be allocating probably around 2 to 4 million, and that will probably be increased as they get their final drill permits. But I think that asset has potential to become the company's best asset. And this is a company that's already got an incredible mine at Tocantinzinho that's in production. We got a royalty on that one. And then over at Oko is another great larger asset. So it's great to see these projects moving forward. A couple other to note, we've got Joaquin is moving forward, that will likely kind of make its way back in production in the next couple of years. We've got Taka that should have some kind of material catalyst events with their 43101 and fully permit here in the near future. We've got 15-mile stream that continues to advance towards production. That's probably a 28, 2029 kind of time frame. La Paria, we noted, the Goslin integration, Castle Mountain, we noted. So all of these things are going to be happening kind of quarter after quarter after quarter as we see these advancements. We see more of these mines coming from, we see the revenue grow. So the company is really in a great, great spot. And again, today, look at the share price. We're still trading at a discount to NAV. So there is a lot of room for this, in regards to kind of an attractive entry point of where we sit today.
So, Brett, you brought up the share price. It has done very well since really June. It's been going straight up since then. Curious as to what your strategy is for future deals, because you do have a credit facility available to you, but now you also have a much higher share price. So, when transacting in the future, do you foresee using shares more so than the credit facility? And talk to us about what you still have available in that credit facility to get some more deals done, please.
Yeah, so going forward, I mean, a goal that I have for the business is to get to, about 100 million US in top line revenue. Currently, this year we should be somewhere kind of based on our guidance, call it kind of in the 12 to 14 million US range. And I think next year, again, we haven't given any guidance yet, but, just based on kind of preliminary estimates, we should hopefully see that kind of get close to about 20. And I think the portfolio by itself, with everything bought and paid for, should get us somewhere north of 50, potentially up to like 60, 70 million US by the end of this decade. So, looking at kind of filling that hole, what is the best way for us to do that? Well, I think, larger kind of producing deals is going to be the priority. Obviously we love high optionality, kind of longer term development assets. That's what we've built our business on. But I think most of those transactions are going to be mainly funded through free cash as the cash flow starts to ramp up, and really kind of focus on bigger deals, using a sensible way, kind of reduce dilution and reduce, any type of additional dilution from that perspective, to really make these types of transactions accretive and get the cash flow profile, up to that kind of initial target of 100 US annually by the end of this decade.
Yeah, it's a process, isn't it, Brett? But it sounds like you have a lot of growth within the portfolio. And look, I just get a lot of questions. Where is the next acquisition going to come from? What else can the company do to keep moving forward? But I'll wait to see what the next news might bring on that front and follow up with you. But in the meantime, I'll post a link to the company's website. Everyone can read over that news release highlighting what happened in Q2. And please, everyone, send me your questions for Brett, and I will get him to address those in future calls. Brett, thank you very much for the update. I appreciate your time.
Thanks, Corey.